Hello class, this is chapter 3 for college accounting. So in chapter 3 we're going to look at the double entry framework of accounting. So learning objective number 1 is define the parts of a T account. So the T account, obviously it looks like a T, so debits are always on the left and credits are always on the right. Whenever we talk about double entry accounting, this is what we refer to. Debit means left, credit means right. Abbreviation for debit is DR period. Abbreviation for credit is CR period. At the very top of the T account is the account title, or the name of the account. So every T account has an increase side and a decrease side. Some accounts increase on the debit side and some accounts increase on the credit side. The debit side is always on the left and the credit side is always on the right. Foot and balance a T account. This is learning objective 2. So I believe this is one of the homework questions. This is cash. This is number 1 step. Foot and debit and credit sides. To foot means total. So the footing of the debit side is $3,500. The footing for or total on the credit side is $3,130. So step number 2, find the balance by finding the difference between the debit and credit totals, or the footings. So debit is $3,500 minus the $3,130 credit, and the balance is going to be a $370 balance. So that goes on the left side. Now, if there was a balance on the right side or a credit side, meaning you owe money, then you would have a footing or a balance on the right side. But in this, most of the times, you'll have a cash balance that's going to be on the debit side. Okay, you never want to have negative cash. Objective 3, describe the effects of the debits and credits on specific type of accounts. We kind of looked at this whenever you did chapter 2, whenever you looked at transactions and the impact on the balance sheet, or the impact on assets equals the liability plus owner equity equation. Debits and credits. To debit an account means to enter an amount on the left or debit side of the account. To credit an account means to enter an amount on the right or credit side of the account. Debits may increase or decrease the balances of specific accounts. This is also true for credits. Here's an example. Assets equals liabilities plus owner's equity. Notice there's an umbrella to give you an example. Debit, credit. Then down below it says capital right here. It's a capital, so anything below that would go under capital. And again, your expenses, revenues, your drawings or dividends to retain earnings, those all close out into your income statement, which is this section right here. That closes out into, your income statement right here, which are these accounts. This will usually go over here, but your income statement will close out into your owner equity. Owner equity closes out into your balance sheet. Assets increase on the debit side, decreases on the left side. This is any asset account, so keep that in mind, which includes cash. Let's see, another example are like prepaid insurance, accounts receivable. Just a couple of examples. Land. Let's see, what else? Vehicles, things of that nature. Liabilities. So a decrease on the debit side, a positive increase on the credit side. So notice how these kind of flip. Capital as well. So the debit is a negative or a decrease, and then a credit is an increase, just like a liability account. Revenue accounts, decrease on the debit side and increase on the credit side, just like other capital accounts. Expense accounts, they flip, increase on the debit side and then a decrease on the credit side. So they go down. If you're crediting a expense account, it's going to decrease. Drawing account. This is whenever you pay dividends or things of that nature. A debit is going to be an increase and a credit is going to be a decrease. So just like it's noted on there. Normal balances. So an asset, debit increase, credit increase, normal balance is a debit. What they mean by at the end, after you close out and do your footing, these are the balances you'll probably have in there. You don't want to have a credit balance in a liability. You don't want to have you don't want to have a debit balance. I said that backwards. So then this table goes through and looks at those accounts. Using T accounts to analyze transactions. So here are steps in transaction. What happened? Which accounts are affected? This is what you always do. Anytime I see a journal entry in the back of my head, and this is what you need to get to be able to do. You have to think, okay, which accounts are affected? And with the double entry accounting, always make sure it ensures that you are debiting and crediting the specific and the right accounts. The third step is, how is the accounting equation affected? Like you have to, in your head, you have to understand how it's affecting the accounting equation and making sure that it balances. So Rohan invested $2,000 in the business, so cash, and then capital. Those are the accounts that are going to be affected because we're bringing in cash and it's going into a capital account. Okay, so it says classify the accounts as assets, liabilities, OE, revenues, or expenses. So we know it's going to be an asset and it's going to be owner equity. Identify the location of the account. So whenever I think of it, I always start with cash. Is my cash going up or down? Well, it's going to increase here. That means I need a credit on the opposite side. So the capital account's going to be credited there. So whenever you have a debit, there's always a credit. Or whenever you have a credit, there's always a debit. Okay, so did Rohan capital increase or decrease in this transaction? It increased, so we would do a plus right there. Okay, and there we go. Increase for $2,000. Did cash increase or decrease? It increased, so it's increased by $2,000. So this is what it will look like side by side. Okay, we didn't necessarily do the journal entry yet, but typically you would do the journal entry initially on your in one of your oh my god, I can't remember the name of it, but so here's purchase a motor scooter delivery equipment for $1,200 cash. Now cash is going out, so automatically you know cash is going out, and when you make a purchase, you made it to equipment. So cash is affected and delivery equipment. Equipment is an asset account as well. So classify these accounts assets. So they're both assets. All we did was move the cash over to a delivery equipment. The reason why it's still asset is because we can sell that delivery equipment, if we decide not to use it. So it says identify the location, cash, delivery equipment. Now next step is it a debit, or credit? So did delivery equipment increase or decrease in this transaction? It increased. So delivery is going to be a debited for $1,200. Increased. Cash, question is, did it increase or decrease? It decreased because we bought it. Cash is going out. So it decreased by $1,200. So our cash account went down. But it still balances because all we did was move cash and purchase equipment. So on our balance sheet, it's still going to be an asset of $1,200. And here's the example. So delivery equipment increased $1,200, cash decreased $1,200. Another one, we purchased a second motor scooter on an account. So anytime it says you purchase on an account, that means you created a liability. Okay. So delivery equipment, and notice it went a liability, is account payable. Those are the ones that we look at. Classify these accounts. One of them is going to be an asset. The other one is going to be a liability. So identify the account. So again, debit, credit, debit, credit. And did delivery equipment increase or decrease? Delivery equipment, if we look at it, it went up. Okay, so it went up. I don't know. Our delivery equipment went up, which means our account payable is going to go up. Okay, so it increased. Delivery equipment increased by 900. Did our account payable increase? It increased because we owe money. So remember how you always have to have a debit and a credit? Here's what I'm talking about. Here's our debit and here's our credit. So there always has to be a debit and a credit. That's why it's called the double entry accounting framework. And just remember, it's in place to ensure that we are properly recording and properly accounting for assets, liability, owner equity, expense, revenue, and dividends or withdrawals. So Rohan made deliveries and received $500 cash. So our cash went up. So automatically, like I said, whenever you see this, and I mean, it's just internal now. But once you get good at it, you'll automatically know what's up. But it does take practice. Cash will go up. So our revenue account, because we made money, so our revenue, we have revenue in it, and our asset is cash. There's the two that are going to be affected: debit, credit for both of those accounts. So our delivery fees increased. Okay. Now, notice that they are both plus, but the thing is, one's on the left and one's on the right. Whenever I said if we have a credit, we'll always have a debit. So our cash increased $500. So this is what it looks like on our T account. So the next one, Rohan made deliveries on an account. So this one, when he made, this time he had made revenue again, but this one means we have a different type of, we're collecting a different type of asset. We're not collecting anything, we're actually putting it into an account receivable account. So accounts receivable increased by 600 and our delivery fees went up by 600, okay? So again, our asset account increased, but it's not cash. They'll probably pay within 30 days, something like that. Paid his part-time employees. Rohan paid his employees $600 in wages. So automatically you're going to pay. You want to pay your employees in cash. Okay, never create a account payable if you can. Sometimes people do it, but I try to stay away from it. So our expense account, okay, and our wages expense, and then our asset will be cash. So the location, whenever our cash decreased, right? So automatically it's decreased. So we have to have a debit. So for this example, it's going to be a debit right there. So debit always has to have a credit. So increase was wages expense, and our decrease was cash. And here's what it would look like: $650 debit wage expense, cash credit of $650, or it went out because you're paying it. Let's see, so Rohan withdrew $150 in cash for personal use. So this is a dividend. He's pulling out his owner equity. Our owner equity account is affected and our asset account is affected. So if they have so those are two accounts. And the question is the draw going to be a debit or a credit? Is the cash going to be a debit or a credit? So our draw increased by a plus 150 and our cash decreased by a credit of 150. And here's what it looks like on the T account with numbers in there or dollar values. And again, when there's a debit, there always has to be a credit. Okay, keep that in mind. Learning objective 5 is prepare a trial balance and explain its purposes and linkages with the financial statement. Okay, so we're actually starting the accounting cycle, journal entries, and then putting them in T accounts, making sure each of your T accounts are properly recorded. Those are the checks and balances automatically. And then we take a trial balance. The trial balance is basically the list of accounts and their balances. It's a totaling of debits and credits. is proof that total debits equal total credits and that the accounting equation has remained in balance after all the transactions that are done. Used as an aid in preparing financial statements. They do close out to an adjusted trial balance, okay? So there's a step and there's a cycle that happens when this occurs. So here's what it'll look like. Again, the title up at the top, Rohan's delivery company, the trial balance, the title of it, and then the date. Okay, and then obviously account title, debit balance, credit balance. And down here at the bottom will be your totals. All your accounts will be listed right in this area. Cash, $370, accounts receivable, $650, supplies, $800, prepaid insurance, $2,000, delivery equipment, $3,600. Account payable, remember we bought equipment on account payable. Our capital, we started with $2,000, and then we had a draw of $150. Then our delivery fees, that's how much revenue, that's revenue we created. And then our expenses, rent expense, phone expense, wages expense. So $5,950 does equal $5,950, so our trial balance balances. And that's why it's called a trial balance, because we want to see if we did our journal entries and our T accounts equaled each other, okay? That's why I said there's a checks and balance in there. So it balances debits equal credits. So linkages between trial balance and financial statements. So the trial balance, we look at it, and then those values go onto our income statement. We pull those values from our income statement, and that goes to our owner's equity, and then our owner equity closes out into our balance sheet. But keep in mind, we were missing a step because we haven't taken a look at the entire cycle. After the trial balance, actually, this should be called an unadjusted trial balance, but we won't get into that. You'll probably get into that until accounting 200. Actually, you will get into it in 200, not probably. So that's the end of the slide presentation. If you have any questions, please email me and let me know how I can help you. The equation is the homework is already posted. Homework will be due in 2 weeks. Okay, thank you. I hope you enjoy this class.